I know some of you may be tempted to beat the traffic, but please stay for this one, because in a fragmented world, standards matter more than ever. And in our panel now, which is Localising Global Standards to Strengthen Investor Confidence, we'll be looking at a number of things. Ratings, audits, and ESG benchmarks are the language global investors rely on, but they must reflect local realities to remain meaningful. So our final session of the day explores how international standards are being adapted without compromising transparency, trust, or comparability. And joining me on stage, we have an excellent panel, including Paul Lund, Head of Corporate Ratings at Fitch Ratings, Dina, Samaha, Chief Executive Officer and Managing Director of ICRS, and finally, Olga, Fleming, Chairwoman, World Sustainable Development Fund. And they will all be hosted by our legendary, wonderful Sally Mousa. So thank you very much. A round of applause for our final panel, please. Thank you.
Thank you, Stephen. Wow, what an introduction. Of course, what we're going to be talking about this afternoon is all about the trust that global capital depends on. And that trust depends on standards, credit ratings, audits, governance frameworks, and ESG benchmarks. They exist to create a common language for risk. But as markets deepen across the Middle East and other emerging economies, the real question isn't whether these standards are adopted, but how we apply them locally without weakening that credibility. And so to unpack all of that and so much more, I'm delighted to be joined by leaders, as you can see, from Fitch Ratings, ICRS, and the World Sustainable Development Fund. So Paul, I'd love to start with you. Credit ratings, of course, are described as market infrastructure. But in practical terms, how do ratings actually improve liquidity and price discovery for issuers, particularly in emerging and developing capital markets?
Yeah, so credit ratings provide a great deal of transparency that perhaps was not there before. And we have, in the credit rating process, I'm assuming everyone's got a knowledge of what a rating is. But it's a relative measure of credit risk, and we have a global scale of ratings. And what they provide, when we talk to issuers, they need to provide us with a certain level of information for us to do the rating in the first place. If they don't give us enough information, we don't continue the relationship. So there is, first of all, a requirement for transparency, a requirement to share a lot of detail, perhaps, that especially smaller issuers, they haven't shared with the market before, so that we can actually undertake our analysis to start with, but also publish it as well. So even if we're not allowed to publish confidential information, we have behind us a great deal of information we've already got from the company that enables us to get to a credit rating. But that transparency helps to inform issuers. It helps provide a benchmark for risk in a particular market, so they understand how, say, a risk in the UAE matches up to a risk of a company in the EU, for instance.
And that's so critical when we're talking about, particularly right now, when you're talking about geopolitical risks that are happening. What are you seeing? What are the movements that you're seeing right now as you're issuing?
So there's two elements. One is geopolitical risk, which really affects the sort of sovereign scales, and the big geopolitical risk here is actually what's the price of oil, and what are the fundamentals behind the price of oil moving forward. Fitch we've recently shaded our forecasts for 2026 and 27 to $63 a barrel. What that means on a sovereign level is how do the local governments, particularly in the GCC, balance their budgets, and therefore what will they need to fund elsewhere? What will they need to do to fund from the debt markets? What will they need to fund from the sort of public pocket, as it were? And also, how much foreign direct investment do they need to pursue in order to help them meet their development objectives? So that was the first real response to that.
Dina, coming to you, when we're talking about local markets, they have nuances that global models don't always capture. How can domestic rating agencies adapt to international assessment frameworks to reflect the local realities without losing that all-important transparency and investor trust?
There are actually numerous challenges, first of which is to ensure that the credit rating agency, they have a national grading scale or national rating scale, which is one of the biggest challenges if they're not parented or partnering with a credit rating agencies that rate sovereigns. So they can do the conversion and the mapping process to the national and domestic rating. So this is a huge challenge. There are not too many of those. As financial inclusion grow into the local domestic markets, there is a huge need to be filled by having new entrants of domestic and locally licensed credit rating agencies into the emerging markets in particular. They're becoming a material, important requirement for the economy infrastructure to function. So that said, the local credit rating agencies, they need to have their own risk differentiated analytical tools to develop a national grading scale. Multiple challenges and variables fall into that as well. One of them is the vintage data, which is very important because it requires a lot of vintage data, probability of defaults, loss given defaults, many of the statistical requirements to start developing a mapping process to equate the relative credit worthiness of the domestic risk to the comparable international grading scale. If that is an achievable target, then one big requirement to have the comparability, the transparency to the international standards, so an investor can make the comparison between the local national rating and the international rating using just a signal to make such a comparison. So part of the analytical pillars that needs to be factored in to ensure that the domestic rating process is comparable to the international standards, they need to factor in cash flow sustainability, business risks, corporate governance, legal enforceability, recovery collection ratios, many other macro stress testing, many other fundamentals kicks into the equation. More importantly, the methodology has to be transparent and publicly reviewed to ensure that the integrity and the transparency is set.
Olga, coming to you, even the best benchmarks fail if the enforcement is weak. So from a governance and legal standpoint, what is it that truly determines whether international standards carry real credibility once they're applied locally?
Yeah, I believe the confidence, the investor confidence is the key sector here. Like, if you don't have the confidence, then nothing is going to happen. And coming back to the answer here, it's really important to keep in mind all the elements, right? But I think the key factor would be how the government is consistent about implementing the government. So it's not about the setting the rules, so we can set out anything on paper. But the question is, how often does the government rotate? And even if it rotates, do we keep consistency in implementing and following the governance and the rules? If we do, I think that's sufficient level for the investors to kind of keep the trust, because all the other elements that maintain kind of out there, specifically the execution, legal enforceability, and so on. So many legal risks mitigate by following the guidelines, following the international guidelines.
Paul, coming back to you, here, particularly in the GCC, we're seeing a noticeable rise in demand for credit ratings. And for you, what economic, regulatory, or capital market shifts are driving that demand, and what does it signal about market maturity?
So, there's two speeds of, or the two levels of credit ratings really coming on the region. Firstly, those are the GRE ones we've already talked about a little bit, but you've got sovereign, you've got supranationals, you've got the public investment fund, ADQ style companies, and they're the subsidiaries, and all of those are wrapped up under a sovereign supported credit risk ultimately. A lot of their ratings are very high. And then on the other hand, you've got smaller industrials and developers, and they're all rated in the non-investment grade level. Some real estate companies, perhaps in triple B level, but most of the other new ratings that we have are in the fast-growing developer area, which are taking on an awful lot of market risk. But they traditionally have been heavily banked. So whenever they're developing a new development, a new tower block, a bank has helped fund them that, but also said, I'm going to take security on that. So what we've seen is a lot of companies trying to free themselves up from that bank security, borrow at the top level, and then also find an alternative diversification of funding. And by issuing a bond with a rating on it, they access a completely different market. And we've seen, I mean, I'll use Bingati as a reference, which is BB- rated. They've been raising quite a lot of additional money, probably $1.5 billion in the last year. But most of their investors are not in the GCC. Most of their investors in Europe. So they're accessing a completely different set of investors. And I think what we see moving to in the future is a better development of frameworks. We have Saudi Vision 2030. We have the UAE's Abu Dhabi plan. We have the Dubai plan. We have Oman 2040, and all of these create frameworks against which companies can raise money, or against which companies can develop, raise money, reinvest, and perhaps pull away from that sovereign support, stand on their own 2 feet with a standalone rating. And that perhaps for investors will diversify investment a little bit and provide a different level between the A pluses and the BB minuses, with different levels of yield. And I think investors are really looking to push money into the region, but at the moment they don't have the differential in yield or risk that is needed.
It's so interesting, hearing about the way that vision and forward-looking vision is going to be part of the process of understanding whether investors are going to be coming to the region, what they're looking at, what they're seeing as going to be possible, particularly in the volatility and uncertainty that we are seeing globally right now. So, Dina, coming back to you, for global agencies, they naturally focus on larger issuers. And so what role do local ratings then play in widening that access to capital for SMEs, as we're talking about here as well, and mid-size corporates as well? And why is that important for economic depth?
True. So SMEs and mid-caps are economically material, but analytically invisible to international credit agencies by virtue of the size. And that put more emphasis for the need to fill in a gap of more entrance of local and domestic credit rating companies to fit that gap. And again, it fits into the regulatory requirement of the financial inclusion, growth strategies. So by having more domestic credit rating agencies with well-structured mapping conversion process to calibrate the international rating standards into local standards, there will be more activity and various pockets of liquidity to support the SME and the mid-size.
I feel like it feeds so much into what Paul has been talking about as well, and making sure that we are growing. So many independents that are coming through. You've been talking about developers, particularly in the UAE and Dubai in particular. And so, this suits that very importantly. Moving on to you, Olga, as well. We often see that companies are technically compliant with global standards, but investor confidence is still fragile. Where do legal governance and or accountability gaps, where are they most commonly undermining trust despite compliance?
I would say, first of all, checkboxing, right? So we say we're compliant, but the question is whether we are actually compliant, because we can put anything on paper. And then I would say probably the legal risks, the legal arbitration, if it's available. What do we talk about in our agreements when we indicate where we go to the court to arbitration? And then if we have the knowledge, then government tries to use the fact that to actually go away from the jurisdictions that we've chosen in our agreement, I think it undermines it heavily, because we are only safe to extent where we can be sure that if we go to arbitration or to court or whatever we choose to, we will have the fair judgment. If we don't have it, anything else doesn't make much sense. But of course, all the areas are extremely important. I'm not going to repeat myself because my co-panelists already have mentioned, but I think, of course, everything is important. But at the final stage, when we negotiate, we always think of the good parts. But when things go down the road, we need to make sure that we actually can execute the agreement, not only our way, but so that every party is confident, right?
Yeah, that is the most critical aspect. And to close off, I'd love to get everybody's thoughts on this. So starting with you, Paul, when we're localizing benchmarks, where is that fine line? Where do you see that fine line between necessary adaptation, but then you're diluting those benchmarks possibly? Who should ultimately be responsible for guiding that as well? Is it regulators? Is it rating agencies, investors, boards? What are your thoughts?
It's a mix by market. But in our ratings, we build in what we call operating environment risks. And it takes into account, firstly, what is the sovereign makeup? So are you in a strongly rated company or a country or a weak country? And you overlay that with corporate level risks. So is there a key man risk? For instance, is it heavily family owned, limited board? Is there a propensity? Are you having a reasonable risk to approach at board level that filters down through the company, or are you over leveraging? Are you taking on too much risk? Is your company unnecessarily complicated in its structure? And all of this is contained within our criteria about this approach, and it's international. So you mentioned briefly ESG. I'll be very quick. You mentioned briefly ESG. The biggest element of ESG is the G. It's always governance that is the biggest issue and the biggest negative. And we look very, very closely at the governance risks across the board, but also the enforceability risks are super important when it comes to how much recovery you might make if a corporate defaults for any reason.
Dina.
Everyone is responsible. All stakeholders are responsible. Regulatory bodies, the financial intermediaries, issuers for the issuance or instruments. But so basically adaptability is when you serve the purpose. And that means that you don't lose the core when you do the conversion process. So we don't dilute the form over the substance. 3 tests, in my view, should be ensured to ensure that the adaptability is ensured and the dilution is avoided. Comparability tests, so when a natural observer can, by watching the signal of the local national grading signal, can equate it to the international standard. Decision-making test that, based on the signal of the local rating that is comparable to the international, they make prudent and sound decisions and conclusive outcomes. And reversibility. One would want to see that if market conditions improve, that gets calibrated into the rating. So that ensures that the adaptability is achieved.
Final word for you, Olga.
I mean, I think pretty much everything has been said. The only thing I have to add is that it's evolving environment. So having a conversation which brings adaptability, a conversation between all stakeholders in the region, globally. So having more of those conversations help to also adjust and understand each other better, and maybe to improve certain elements for actual assessment and implementation.
Such an interesting discussion. We are out of time. Ladies and gentlemen, please join me in thanking our speakers, Paul Lund, Dina Samaha, and Olga Fleming. Thank you all so much. Thank you.